We're back. This is Ask the Compound. On today's show, we're discussing questions straight from our audience on portfolio strategies for early retirement in your 50s. We've actually got a lot of early retirement questions lately. Bull market phenomenon.
Is that an economic indicator?
Yes. Can you use ChatGPT as a tax advisor? How dividends fit into a retirement withdrawal strategy? When to take capital gains on the sale of a property? And how to be more tax efficient when you go FIRE. That's real early retirement. Remember our email here, askthecompoundshow@gmail.com. Today's show is sponsored by Rocket Money. Rocket Money is a personal finance app that helps you find and cancel unwanted subscriptions, monitors your spending, helps you lower your bills so you can grow your savings. Rocket Money will negotiate bills on your behalf. Rocket Money recently did this for me. All I had to do was click and log into my internet provider and click a button, and they said, we got it. We're going to negotiate for you. They could save me $20. Pretty good. I didn't have to do anything. It's like a personal finance concierge. I think I will be having them negotiate on my behalf in the future because I hate waiting, calling them 1-800 number, waiting, transfer to this department, transfer to that department. Yes. Rocket Money has over 5 million users and has saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all the app's features. It's a great deal. Stop wasting money on things you don't use. Cancel those unwanted subscriptions by going to rocketmoney.com/ATC, just like I did. That's rocketmoney.com/ATC.
The most recent one I got yesterday was it said unusually large transaction, and it was my wife at Whole Foods with my Prime credit card. So
it's kind of nice to, right? Yeah. Keep tabs on things. Right. I thought you were going to say it was like Oatly options trading after hours.
No,
unusually large transaction.
No. I don't do that after hours.
Okay. Yeah. All right. Good questions today. Let's do it.
All right. Up first, we have a question from James. My wife and I are both 50, and we retired from our jobs about 3 years ago. We've been living off of our investments. However, we were harshly reminded in 2022 of the impact of volatile returns versus smooth returns when drawing upon the principal. I am a bit of a spreadsheet warrior and have run many models going out 50 years. I assume a 2.25% inflation rate and a composite 15% tax rate, which I hope to manage even lower. Our assets, including our home, are about $4.4 million, broken down as 60% taxable/liquid, 35% in IRAs, and 5% in Roths. Our only debt is a 2.1% mortgage that will be paid off in 10 years.
2.1%, that has to be like an all-time low.
That's
close to it.
Not bad. Part 2. You've often said when you've won the game, you stop playing, which I probably need to shift to more than my current in for a dime, in for a dollar approach, which I can identify with that approach. I'm considering perhaps going all in on JEPI or a similar investment, with my ideal scenario being 5 to 6% yield plus 1 to 2% annual appreciation. Drawing from principal during market downturns would have minimal impact, and this math would work really well for me until age 59 and a half and beyond. Other than market declines in the principal, I'm trying to think about other risks I may not have considered and alternatives to this approach. The wild swings created by adjusting plus or minus 50 bips in long-term returns are incredible with compounding. That's the name of the channel, Compound.
I, too, am a spreadsheet warrior. I made my first real retirement spreadsheet right out of college, my very first job. I made a bunch of assumptions: savings rates, market returns, asset allocation, future income with inflation kickers, all this stuff. That was roughly 20 years ago, I guess. None of it played out like I thought it would. Spreadsheets are linear, but life is lumpy, I like to say. That doesn't mean you should forego the spreadsheets altogether. I just think, because I think setting expectations is a huge part of the investment planning process, you just have to go into that process with the understanding that, like any multi-decade or multi-year investment plan, involves guesswork that needs to be updated as reality plays out. So 50 years is an incredibly long plan. So he's saying, hey, if my wife and I lived to we're 100, what does this look like? I give him kudos for trying this. Obviously, taking out inflation at 2 decimal points is a little aggressive for 50 years, but I like where their head's at. So James is correct in stating that 50 basis points here or there can make a huge difference over 50 years. So Daniel, let's do a chart on my first one here. I just did growth of $100,000 over 50 years, and I did a 7.0% return for the baseline, and I said, what if it's 7.5%? What if it's 6.5%, right? Plus or minus. 7% return on $100,000 over 50 years. This is a very long time to compound. Is like $2.7 million. If we go up to 7.5%, just 50 basis points increase in return, we're looking at $3.5 million almost. If we go down to 6%, 6.5%, we're down to $2.1 million. So that's a huge difference in the right. So again, this is 50. And obviously there's a bunch of other assumptions. Dan, you can do chart off. savings rates, withdrawal rates, tax rates, all this stuff. So I think one of the hardest part about financial planning for these people who are spreadsheet warriors is the fact that you have to throw precision out the window. It's just not attainable. And you have to kind of roll the punches a little more and course correct along the way. Your initial plans are never going to come to fruition. Those expectations are almost always wrong. That's true over 50 years or 5 years or 5 months most of the time. So that's out of the way. Let's get some other details. James says the 2022 bear market was a wake-up call. I think so. He wants or needs more stability in his portfolio. I have no problem with that. I think bear markets are never easy to deal with, but in retirement, those drawdowns are even scarier because, listen, you're sitting at like an all-time high in market value probably. Young people have time and human capital and income and future savings at their disposal to wait out bear markets and then lean into them by buying more at lower prices. Retirees don't have that same luxury. So you could still have a few decades ahead of you for retirement, but you don't want to be selling stocks when they're down. That just compounds your problems, right? So I gotta say, in for a dime, in for a dollar is not a phrase I use very often, but my translation here is that James and his wife are taking too much risk in their portfolio. Is that your definition, Duncan?
Yeah, I mean, it
Okay.
sounds to normal people probably
Again,
like
good-
a risky situation.
Yeah, good on them for recognizing it. But now they want to go all in on a covered call option strategy. I don't necessarily have a problem with this. JEPI is one of the ETFs that we get the questions on most in our inbox. So we've actually talked about JEPI on Animal Spirits for in our Talk Your Book segment with the portfolio manager of the strategy at JP Morgan, Hamilton Rayner. So listen to that episode if you want to learn more about it.
That's great.
The TLDR is it's a lower volatility strategy than the overall
What
market.
is the underlying again? Is
should
it
be.
S&P?
No, that's the options. The underlying is just more low vol, higher quality stocks.
Okay.
So you're getting more income from dividends from these stocks, but also income from the options.
Okay.
So if you're selling options on stocks, you should see a lower volatility. So that means when there's a raging bull market, you should go up less. When there's a bear market, you should go down less, right? Because the income is, and the fact that they're low volatility stocks. So it does throw off a decent amount of income from that combination of dividends and option income. What's not to love? But I'm just not a big fan on going all in on anything, especially during retirement. Because here's just some of the risks you have to contend with. Longevity risk, right, that you're going to run out of money. Inflation risk, seeing a lower standard of living. Market risk that we've already talked about, bear markets. Interest rate risk, you could see fluctuations in your fixed income over time. That, sure, 5 to 6% sounds great, but that's going to move over time as stocks move. And then sequence of return risk is just that you get poor returns at the outset of retirement is a big risk. And those are just portfolio management related risks. We're not talking about health risks and unforeseen expenses and family issues and just life getting in the way of your best laid plans. So I still think your two best forms of risk management in retirement are diversification and flexibility of your plan. So the good news is we're talking $4 million of net worth, including the home. You've obviously thought long and hard about your investment plan. You say you won the game. I do have mixed feelings about the won the game thing. And I'm sure I've said this before, but on the one hand, it seems silly to put your capital at risk during retirement when you've already saved enough money, you don't have the income to come in help. On the other hand, when you retire in your 50s like this, James and his wife did, you could have 20, 30, 40, 50 years ahead of you for retirement, and you still have to compound your money because you have to keep up with inflation and your living expenses. And so I guess maybe the conclusion here is maybe it's time to bring in a financial advisor so you can just enjoy your winnings without stressing too much. Because if that initial bear market is going to stress you out, I don't think the future ones are going to get any easier. And again, I like how they're thinking about income in retirement. I don't love going all in on any strategy in retirement and having that one strategy define the outcomes for what's going to happen with your money, especially when you're done working.
Also, I think it's worth mentioning, I see some people seem to think that JEPI is like a buffered type ETF strategy. It is not buffered, correct?
Yeah, it's gonna fluctuate. It's gonna have losses.
Yeah.
It won't go down as much as the stock
protecting.
market, but it's gonna go down.
Yeah.
Duncan, I feel like you've probably sold some options in your day against stocks you own.
Oh, definitely, yeah. Barry gave me a
Okay.
hard time about it. He heard me talking about selling calls, and he doesn't like that strategy.
Again, I don't think it's a bad strategy. I think if you're going to do that, it should be part of an overall strategy with other strategies as well, especially in retirement. That's the biggest thing. So yeah, I wouldn't. The 50-year plan is good and all. I wouldn't worry about that as much as I would worry about taking things to the extremes just because you had a bad bear market. I think you can have other sources of volatility reduction and liquidity and these sorts of things in retirement to see you through.
Also, speaking about my my portfolio and my investments, I just want to clarify. There were some comments of people giving me a hard time about the zero coupon, bond ETF that I was talking about buying before the rate cut. That wasn't a short-term trade. I wasn't like trying to flip that in a week or something. We're heading into a cutting cycle, correct? Most people don't think that was the only cut, I'm assuming, right? So just everyone needs to calm down. I didn't buy it as like a week-long trade or something. I'm in it for a while, so.
All right.
It's okay.
Duncan.
Everything's going to be okay.
Buy and hold for you is like what, 6 months?
Yeah, I mean, that's, yeah.
Okay.
Yep.
All right. Next question.
Okay, up next we have a question from Corwin. Apparently, Uncle Sam doesn't want me to get married. I had no idea that there were extra taxes baked into the Affordable Care Act. Shout out to my fellow veteran, Bill Sweet. I'm referring to the net investment income tax and the additional Medicare tax. I've never heard of these things. After 15 years in the military, I've reached a point where I make around $155,000 after next year's bonus. I've been with my girlfriend for a few years and was excited about popping the question. However, she makes $125,000 annually, so if we get married, we're going to owe an additional 0.9% on all income over $250,000 annually and a crazy 3.8% on any interest in our savings account. It looks like if we just don't get married, that tax won't apply to either of us. What the hell? Does Uncle Sam really not want me to get married?
All right. Corwin, thank you for your service. This is like a weekly thing now with veterans. So let's. He shouted out Bill Sweet. Let's bring him in here. Bill, this is a long question, so we had to cut it off a little bit, but he said he's getting his tax advice from ChatGPT. Are you down with that? Are you okay with using that as a tax advisor? How do you feel about the tax information on there?
I love it when Corwin and other veterans are seeking tax advice. GPT does a great job with summarizing, but the hallucination problem is not something you want to explain to the IRS, right? If you're trying to fill out a tax form and explain that you're paying less taxes because ChatGPT told you.
AI told me to do it. This is not my fault.
I don't think that's going to hold up in court. Yeah.
Okay.
It's kind of like, honestly, it's like Adobe AI stuff. Everyone's like, oh, can't you use AI editors and stuff? And it's like, for like 20% of things, it's useful.
Yeah.
Check your work, obviously. Yeah. Is any of this legitimate, though? Is ChatGPT right here? Is he going to get dinged for getting married because of where he sits on the income threshold?
Yeah, and I'd like to welcome Corwin to the ranks of the higher income taxed investor. So yes, the net investment income tax and the additional Medicare tax, those are two real things, Ben. Dating back to 2010 from the Affordable Care Act. At that time, they were instituted two taxes that kicked in for anyone earning $200,000 or more, right? And that's a large amount of money in the world. Let's be very, very clear about that. However, those amounts were not adjusted for inflation. So back in 2010, pre all this, the post-COVID inflation wave, that was roughly about $120,000 a year, which again, not a small amount of money, but yes, they kick in. So to illustrate them, I created a chart. So Dan, can we chart on, please? So let's take a look. On the left side of the chart here, that the 3.8% net
we needed AI to put your face on Uncle Sam here.
That's not a bad idea.
Good idea.
We'll have to ask Corwin. The net investment income tax kicks in. You're going to pay 4% on your investment income above those thresholds. Again, $200,000 joint, individual. And notice that doesn't double, right, for a joint tax return. And that's the situation that Corwin finds himself in, is that he and his future spouse, Mrs. Corwin, are going to be subject to these taxes if they filed a married filing joint return. And unfortunately, there's no way around it. You're going to pay that additional investment tax, and you're going to pay the additional tax on wages, but it only applies to above those thresholds. And so can we chart off here? What I did, Ben, to take a look was I did some math on what this marriage penalty is going to cost Corwin and Mrs. Corwin.
Oh, wait, are there other benefits that we're not talking about here?
No, the benefit is you get to help fund the U.S. healthcare system. That's a pretty big one.
Okay, so you're going to tell him to not pop the question then?
I wouldn't go that far. So there are lots of benefits to getting married. I was going to do a cost-benefit analysis coming up, whereas Ben and
don't do that.
This is so romantic.
That's
how Ben Stiller almost blew it with Jennifer Aniston on Along Came Polly. Do not do the cost-benefit.
He did the math, yeah.
Ross did it to Rachel on Friends. Yeah, it's a bad idea.
We're tax guys, though, Ben. This is what we do. We sit down and do this. We are the spreadsheet warriors you referenced in the prior question. But yeah, on $290,000 joint, the total Fed tax is going to be about $50K. Of that, $650 is going to be composed of this net investment income tax. So the question I would ask the both of you, is your marriage worth $650 a year?
Is that all? Okay.
When you put it like that.
Yeah, all the benefits you get along with it. Yeah, it's about 20 basis points of additional tax. So my advice with all this stuff is, look, this is reality, and unfortunately, the more income you make, the more tax you're going to pay. This is a good problem to have.
Some of this stuff could sunset in the coming
Notice
years
though
as well,
that
right?
neither Ben nor I actually answered that question.
Yeah. No, this is not a sunsetting thing. So, yeah, the tax code changes in 2026 potentially, but this is permanent. This is part of the tax code indefinitely unless it gets repealed. So, but Ben, I wouldn't base your decision to not get married or not on $650.
Right.
I wouldn't.
Yeah, he's
go
obviously
that
another spreadsheet warrior. The fact that he even knows this stuff and is like looking into it before he gets married. But this is one of those things where he could also say, listen, it's not just a $650 we're saving. I'm saving 10 grand on a ring.
Yeah.
We're saving 40 grand on a wedding.
Oh, man.
I mean, let's do the compounding here. I'm just throwing it out there. How much for
Yeah.
a wedding dress?
Yeah, I don't know. You just don't live your life on a bank account, Ben. You know this. So at some point, you have to trade those hard-earned dollars into life experiences. I think one of the most important decisions you can make is to choose Miss Corwin and meet her in the aisle next year. So
Yes.
I would go for it.
And make sure she definitely doesn't see this episode of Ask the Compound.
Exactly. Block this chance. No.
Bill, so wait,
Yes, sir.
when you get married though, you get there are tax breaks and things that you get, right? So I mean, wouldn't those?
That's what I
more
was
of an
talking
offset
about.
this?
Isn't there some
Yeah.
benefits?
Yeah, I sat down this morning to take a look at a tax return, and assuming there's no kids or anything else, no. I mean, the tax rate is exactly the same plus this net investment income tax. The problem was when they did this for joint versus married filers, they didn't double the exemption, right? So like the first $200,000, this doesn't kick in. So they did not increase that to $400,000 for folks getting married. It's just $250,000. Why? I don't know. You'd have to ask Congress. But the other issue, if you don't adjust things for inflation, very, very slowly, people's incomes tend to rise at the rate of inflation. That certainly happened to Corwin. Unfortunately, this just going to mean more tax in the future. I don't really fully see a way around it. Guys.
I have two words for you: cubic zirconia.
Plastics.
Diamonds are a.
Don't listen to Ben.
Yeah.
Don't listen to Ben.
Next
Cliff in
question
the
before I
chat
get in
said.
trouble.
Cliff in the chat said, "I always avoided high income, but it wasn't my plan."
Yeah, there you go. Yes, good problem to have. All right.
Yes, exactly.
Next question.
Exactly.
Okay, up next we have a question from Bob. Can you discuss retirement withdrawal rates related to dividend returns? We hear a lot about the 4% rule, but not how it should be calculated considering dividends. For example, if you have $1 million in stocks and are receiving 2% in dividends, what should your withdrawal rate be? If it's 4%, you would be taking out $40,000 per year. However, you're also receiving $20,000 in dividends. So when using the 4% rule, how does one consider dividends? Are they supposed to be reinvested? Can you really spend $60,000 a year?
All right. Dividends are one of the most underrated parts of investing in the stock market because they're part of the deal. It's total returns, right? So let's throw up a chart here. I had our chart kid Matt make for me. We looked at the growth of a dollar since 1950 with dividends reinvested and without dividends reinvested. So that would just be the price return, right? So without dividends reinvested, a dollar grows with over $300. With dividends reinvested, we're talking $3,500. Huge amount of compound, kind of like our first example where over 50 years, it doesn't take much to have the compounding. And it's kind of hard to do the math on this when you say, well, dividends are accounting for 70% of the returns or something like that. It's not really the case, but it's the fact that over long time periods, compounding can help. So my other favorite stat is that dividends are not like bonds and that the yield, even if the yield stays similar, it's because it's keeping up with the stock market. So since 1950, the S&P 500 dividends have grown at an annual rate of 5.7%. That's 2.2% per year over the rate of inflation, which has been 3.5% over that time. Dividends are a really good inflation-adjusted income kicker. So you don't have to reinvest your dividends. I guess getting back to our first question about early retirement, I think you just want to be kind of flexible. So you could just spend the dividend income you get in, or you could sell shares in your stocks to create your own dividends. So it's kind of like 6 of one, half dozen of the other. But I mean, Bill, what do you think when you come to these plans? Do you tell people let's bank on the dividends and then 2% is the dividends and then the other 2% can come from somewhere else? Or is it kind of like it's all mental accounting and it's got to come from somewhere anyway, so who cares?
Yeah, I do not, Ben. And I think our friend Bob, great question, but I think Bob's making a category error here. For me, the 4% withdrawal rate, that is based on your total portfolio value. As you gentlemen probably know, it dates back to a portfolio study, a modern portfolio theory study, roughly 2024. I think the gentleman was Dr. Gevin, took a look and said, what is a safe withdrawal rate for a portfolio that should survive most markets, right? Based on historical data. We all know that past performance is not indicative of future results, but the paper came up with a number of 4% off of withdrawal. So $1 million portfolio, you should be able to draw roughly $40,000 a year as a starting value and do that annually each year
And
without.
I like to tell people that gets you through the worst case scenario over 30
Correct.
years.
Correct. But
Worst
obviously, but obviously, if the first 10 years of retirement, you average an 8% rate of return, your safe withdrawal rate is well in excess of 4% during those years. But you just need to factor in, Ben, that ultimately the portfolio returns are not guaranteed, right? Unless you're investing in a single premium annuity, we don't know what the future rate of return is going to be. Some years you're going to get 40% from the market. Some years you're going to get negative 50, right? And so the 4% rule sort of helps you plan for that, but it is a rule of thumb. At Ritholtz Wealth Management, we take a look. We take a more sophisticated approach. We look at your goals. We look at your fixed spending. We look at your variable spending. We have a model that has inflation expecteds built in, starting interest rates. We put that all into a blender, and then we're trying to get an 80 or 85% success rate. But the most important thing when it comes to safe withdrawals is what is a safe withdrawal in 1 year may not necessarily be a safe withdrawal the next year, and very much dependent on the path of returns. You said the magic word before. Sequence of return risk. It's a very real thing. 4% is a useful rule of thumb. But my answer would, Ben, I would look at a total return portfolio. I wouldn't let the dividend rate dictate what my spending is going to be. I would look much more broadly than
And I think sometimes people look at the dividend and go and think they're like skirting the system and going, oh, if I just take that 2% and spend it, it's kind of like they're cheating the system. But no, it's coming from somewhere either way. Either the dividends get reinvested and it juices your returns more, and then you have to sell your shares or you sell your fixed income or whatever it is. It's all one big bucket, so it doesn't matter where you take it from.
Yep, and there's a lot of great work from O'Shaughnessy and the asset management and more recent work saying that dividends are actually quite tax inefficient, right? It's a great marker. However, buyback yield is probably a better metric of a healthy company because they have excess cash flows, and if they're using that to buy back their stock, effectively that benefits all the investors without having to pay tax along the way. So dividends from a tax perspective are not ideal relative to other factors.
I think I got one more chart here too. Daniel, do we have my drawdown chart? So I did this before on a previous show. But I looked at dividend drawdowns in the S&P, and you can see dividends don't fall nearly as much as the stock market because companies hate cutting those dividends. But in the 2008 crisis, dividends fell 25% or so. So that's why you have to be flexible with these things and not just rely on any one source of income, I think, to power you through
So
retirement.
wait, when a company cuts its dividend, it no longer is eligible to be called an aristocrat, right? That's growth. Consecutive.
Yeah, you can't hold your
picturing-
pinky up when you drink your tea.
I'm picturing the Winnie the Pooh meme, right? It's like dividend aristocrats all the way down. But I think just relying on dividend income to basically pay bills, like you said, Duncan, during the Great Recession, during COVID, dividend yield's not guaranteed. It's the board's decision each quarter. So I think in a total factor, it makes more sense. I'm just thinking more diversified. Dividends that's one way to earn yield. It's not the be all end all. It's not the
Yeah,
just asked the
there's
chat-
some years you can do it, but I don't think doing it every year is going to make your life easier.
I just asked the chat if they prefer dividends or buybacks, and 60% said dividends. People love dividends.
People love dividends. Yeah,
It's a psychological thing, I think.
it is.
Yeah.
I get it.
They're paying you to own the stock.
Exactly. The money just shows up in your account.
Right.
Let's do another one.
All right, up next, we have a question from Adam. I have a question about my mom selling her share of ownership in the family farm. Unfortunately, my dad was diagnosed with dementia in the past year and is now in a nursing home. My parents have enough saved to cover the costs of his care for the next 2 years. However, my mom will need more liquidity and plans to sell her third of the family farm to my uncle. He still farms the land, and his kids plan to continue farming. The land is being appraised, and the sale will take place within the next 3 to 4 months. There will be a capital gains tax on the sale. Is it optimal to make the sale in January 2025 and not have to pay the capital gains tax until my mom files her taxes in 2026? My thought is her money can grow in fixed accounts in the meantime. Since this money will be going towards medical expenses, are there any tax advantage approaches that my mom should be aware of?
Okay, so this is obviously
Sorry to hear.
this is the retirement planning of life getting in the way, obviously, of best laid plans. Bill, so obviously sometimes with taxes you don't have the ability to be tactical like this, but it sounds like because it's a family sale, maybe they do. Right. Is there a better time to sell here when it comes to taxes so they can push this off a little bit more?
Yeah.
Does it make a difference?
Yeah, I think Adam is onto something. Particularly, Ben, you said it. What makes this unique is it's family. So presuming that you have a trust-based relationship with your uncle, I would argue yes. Planning for a January 2025 capital event, that would make a lot of sense because it would basically allow mom to wrap up her 2024 tax return. And then ultimately, the gain from that sale, the tax is ultimately going to do, the final tax bill is going to be due in April of 2026, right? So if that sale gets executed in January, you're looking at a 14, 15-month time horizon that potentially the money that could be due for taxes from the proceeds from the sale can be invested safely in some safe yielding vehicle. I'd recommend short-term bonds, something of that nature between now and April. And yes, she could just clip coupons and earn the yield on that cash that would otherwise be going to pay tax. Now, I do say final tax because there would be an estimated tax due. However, we could benchmark that, Adam, to mom's 2024 tax balance due plus 10%. So there's a safe harbor for estimated taxes that as long as you pay 110% of your prior year estimated tax on April 15th, June 15th, September 15th, and then January 15th, you can then wait and basically do a big lump sum balloon at the end in April of 2026. I think that's a really interesting strategy for this situation.
Okay. So work with the uncle, basically.
Yeah. Yeah. And the other thing I might throw out with uncle and sit down with the CPA and talk about this, maybe structure it as an installment sale. And so if the installment is, if there's a structured sale where there's an installment in pieces that occurs partly in 2025, partly in 2026, maybe stretch it out to 2027, the capital gain could effectively be stretched over 3 tax years. There's a lot of interesting things you could do with taxes here. But the second part of Adam's question had to do medical expenses. Again, very, very sorry to hear about Dad. I hope that he's okay and wish him a happy time with Mom for the time that we have left. But any payments for skilled nursing care, those are medical expenses. Those are deductible for Mom on her Schedule A. And so those expenses would help to reduce the burden of the sale. And again, if this can be stretched over a few tax years, I think that's probably making the best from a tax perspective of a really difficult situation.
So get with a CPA on this.
Yeah, I would sit down with a CPA, a qualified attorney, and sit down and talk about a 3-year structured sale. That make a lot of sense to me.
That makes sense.
Yep.
Duncan, no one asked in the chat, but I want to know, what is the stuff that you're drinking that matches your shirt and Bill's shirt? You guys are both wearing dark green, and you're drinking something dark green.
It's matcha.
Oh.
Yeah, I don't know what that is. It makes me want to throw up, though.
It's basically blended up green tea leaves.
Yeah.
Oh, okay.
It's good. I like it.
It's good for you. It's a little
It's
gritty.
good for you, but it's also good. I like the taste of it.
Me too.
Sorry, I
Nice
don't drink green.
nice and
I don't
gritty.
drink green stuff. Number 1 rule of mine.
Really?
Come on.
Wow. Jeez. No green beer? You just hate St. Patrick? Like, what's the deal?
Ah, shoot. You got me.
You definitely
the
drink a green
Shamrocks.
beer.
Oh, yeah. That's good.
Maybe also
Once a
Midori,
year. Once a
Midori
year.
sour. I can
Once
see
a
Ben
year.
with a Midori sour.
Yeah.
All right, we got one more.
Okay, last but not least, we have a question
Called
from,
me on my crap.
from Lap. I'm in my early 40s and recently fired into 2023. And those new here, FIRE is financial independence, retire early. I live abroad on my savings at $2,000 a month and 0 earned income. I have about $100,000 in cash and treasuries and $950,000 in VTI and individual stocks. $600,000 in brokerage, $200,000 Roth, and $150,000 in traditional. Next year, I won't reinvest the dividends for $7,500 a year and $16,500 for my savings. I will replenish the $16,500 by selling individual stocks from the brokerage account. And I also want to slowly convert the traditional IRA amount into the Roth IRA. I believe both of these events would count as taxable income. What is the best strategy to minimize taxes? How can I convert the traditional IRA to Roth IRA each year?
Okay, so 2 early retirement questions today. This is also kind of gets into the last time you were on the show, Bill. This person is living abroad to live cheaply.
Yeah.
I think this seems to be kind of the FIRE game plan is $1 million in savings and then $25K a year to live on. I don't know why those are like the benchmarks, but that seems to be what they go for. So this is really early retirement.
Yeah.
And personally, I could never do this, but I do have respect for the people that like have a severe amount of delayed gratification. It's like it feels like a form of financial torture, but I guess that's what makes a market, right?
Financial torture. That's the name of our investment.
Yeah, and then you
investment
retire in
show.
your 40s and you live abroad, and
Yeah.
who knows? Not for me, but more power to you if you can.
Right.
So this is another person who's also not going to reinvest the dividends, right? This
Right.
seems to be a popular strategy today.
Recurring theme, yeah.
What are we doing for tax strategies for the FIRE crowd here? Because obviously the earned income is going to be very low. It's just, I assume, unless they have a FIRE blog or something, it's going to be just investment income. That's all they're going to be paying. So the income should be relatively low. would be my guess. So anything else they can do here, especially for the traditional to Roth conversions?
Yeah, so let's just start with the investment income tax. We started this show with Cormac, our guy Cormac, looking at a $200,000 income. We're talking about a $17,000 income, right? $7,000 plus some capital gains. Good news, standard deduction in 2024 for a single individual is $14,600. That means there's going to be no tax on that investment income, assuming there's no other income, which, again, to your point, Ben, is a great place to be. There's a lot of debate over the...
So their taxes are going to be very minimal.
Yeah, if anything. So I'm presuming overseas, they're probably not required to file a state tax return, although each state's a little bit different. But you are required to file a federal tax return no matter where you live. So yeah, probably not going to owe any income tax. Or if it is, it's going to be a couple $100s. So that's awesome. So the next part about Lap's question is he's starting to think ahead, right? And sort of think about, okay, well, if I'm in a low tax situation now, I have this large-ish amount of traditional IRA assets. Why don't I fill up my low tax brackets now via Roth conversions? So Daniel, can we chart on my next chart here? I did some math for Lap. I came up with about $50,000 of Roth conversion. And the way that I got there was factoring in the standard deduction, like I mentioned before, and then the 22% tax bracket kicks in at roughly $62,000 for a single individual this year, meaning that any income that is AGI less that amount, and that is everything. AGI is Roth conversions, it's interest income, it is dividend income, the whole ball of wax. If we can stay below that line, we're going to be in the 12% ordinary income tax bracket. And what's really neat about that is the capital gains rate for that, the long-term capital gains is 0.
So you're saying doing $53,000 a year or total?
A year. So this would be analysis for 2024. And really, like the big thing that we don't know from Lap is he needs to replenish $17,000, right, of selling stocks. How much of that is capital gains? That's going to be where the needle is. So if we add that to investment income, we just need to stay below that roughly $61,000 mark. Maybe it's $60,000 to be safe. Somewhere in that neighborhood, that's what I would consider. And Ben, what that would mean is you're going to pay 12% on that Roth conversion, but effectively you're not going to be paying the higher taxes along the way, hopefully later. And so converting now would potentially keep that income from the 24% bracket in the future. And maybe you just get started early, right? You don't need to do a full $50,000 conversion, but if you wanted to, not a bad thing to think about.
So you could do it over the course of 3 to 5 years, potentially.
Potentially,
something like that.
And do it
because
over
if you're a Roth person and you retire in your 30s or 40s, or a FIRE person, you want a lot of Roth assets.
Mm-hmm. Mm-hmm. I would think so, yeah, but it may be question the premise. So ultimately, we do know that tax reform is coming probably in 2026. Tax inflation, we talked about inflation a couple minutes ago, but inflation, the brackets do tend to increase over time as well. So I might even push on the premise, do you need to do a very large amount of Roth conversions this year? If we take a look, it's $150,000 in traditional assets already. So ultimately, maybe you don't want to fill up all the way in the lower tax brackets right now, Ben. I just don't see a lot of harm because I do expect the 12% bracket to reset to 15% in a couple years. So
right, because the income's so low, there's a ton of flexibility here.
Correct.
Speaking of taxes, what are the odds that the government at some point steps in to try to recoup some more money from people retiring early like this? Because it seems it's a little bit. I could see it being considered gaming the system, right? Where you're retiring early and then taking out very little, so you're not paying many.
I hear people say that about Roths too. What if the government backtracks on this? I don't think the government is dumb enough to go after retirement stuff like that. I feel like that's just a whole hornet's nest. That's my personal feeling.
Sorry, I'm just trying to not laugh out loud here.
Yeah,
Ben's they'd never make a bad decision.
Fair.
Yeah, being intelligent is not a predicator. Yeah, I think it's just such a small community, to be honest. It's not like people are making headlines. Most Americans are hardworking. Most folks don't have this opportunity. So, to specifically target folks that are early retirees, I don't know. It just seems a little bit cruel to me, especially given that they play by the rules. So, the entire time that Lap was working, I'm sure, and earning and saving, he was paying his fair share of taxes along the way. Why not use the system in retirement to enjoy the fruits of his labor?
Right.
I wonder if
the
people in the
average
1800s
retires at age 90, so they're probably a little jealous at people who retire early.
When people lived till age 40 in the 1800s, was FIRE at age 10?
Yeah, exactly. Well, no, nobody retired. The game
when
plan.
you graduated high school.
Died.
I think Ida Mae Wells, she was the very first individual to receive a Social Security check, and I think that at that point the life expectancy for a female was 64 years old, right? So relatively shorter timelines. But yeah,
is that another consideration for FIRE people that they pretty much won't get any Social Security or much at all?
He would, based on the time that he was working. So yeah, as long
How
as
many
he
years do you have
qualified
to
for
work
the system,
to qualify?
I believe you have to have somewhere in the neighborhood of 30 credits. So it's somewhere in the neighborhood of 10 years. You basically have to put about 10 years into the system to get enough credits to qualify for Social Security and Medicare. But the question is, will it be enough, right? And so I don't know, but that would be the question.
But to your point, Bill, in the finance community, the FIRE crowd seems way bigger than it is because there are bloggers and people talk about it. But in the grand scheme of things, it's a small percentage of people.
If you're not working, what do you have time to do? Post a lot on message boards about your financial planning tactics, right?
Yes.
So yeah,
And watch podcasts.
Right, and
why we
hopefully subscribe to Compound News on YouTube. But I give people a lot of credit for this because this is not a traditional path, and ultimately, my presumption here is Lapp worked really, really hard to get to this place, and so I think he deserves a lot due to the fruits of his labor. He might have built a company and sold it and made the world a better place. So
Yeah.
God bless him.
And my other assumption is he has no kids because kids are very expensive.
Or he's raising them in Denmark, Sweden, or some other country where strong social safety net. So we'll see.
Yes.
God bless him.
All right.
Good luck to you, Lapp.
Great questions today. Bill Sweet, thank you as always, our Roth man. Did you guys
to be
plan the
back.
green today? Green.
did.
Yep. We always talk about what
Coming
we're
correct. The leaves are turning yellow and red, so we're making it up inside.
All right. askthecompoundshow@gmail.com. That is our email. Every week, we're inundated with emails. Great questions. We appreciate it. Just make them a little
and
shorter.
On that note, we get a lot of questions. Not to brag, we're a good problem to have. We get a lot of questions, but we have a doc where we list tons of questions. So if we haven't gotten to yours, we'll probably get to it down the road at some point. It's a very long
Yes,
list.
we save them all. We don't
we
get
save
we don't
them,
kick them
yeah.
any out.
Yeah. We don't get rid of them. We save them.
All right. Subscribe, like, review, all that good stuff, and we'll see you next time.
See you, everyone.